Hello. This video is going to be one of my rambling videos, but I want to cover a few things that I've made adjustments for. First, we are looking at a chart where I just picked a coin at random, and that will become a little clearer later on why I chose this coin. But I chose my two most preferred winter recipes to represent this chart, and I will post a link to this chart in the description below. But these are my winter preferred recipes. These are the ones I find that work well for me. The MACD parabolic stop and release, and the Ichimoku moving averages. Now I've made modifications to this. I took out the MACD RSI just because it didn't fit my trading style. It's a very good process, and I definitely encourage you to continue to examine it. And another one that does very well, that is also very good, is the MACD stochastic. Both of them work well at different degrees. I would say the stochastic and the RSI are neck and neck, and probably in between these two if you're looking for something that's not as aggressive as this one and not as conservative as this one. But for me, these two handle most of my coins. Anything above the 500 million mark, I use the MACD parabolic SAR. Anything below the 500 million mark, and even some of the 500 million mark coins, I use the Ichimoku cloud. Nano and Dash are two coins that do great with this process and really do very well with limiting my exposure. I like ADA and Algo with the MACD parabolic SAR. It really fits my particular risk assessment very well. But before I continue, I want to talk about a change I made in the trailing module. I've modified the retracement values to allow 0.01%. I have found this to work exceptionally well in mitigating unusual market conditions, particularly when you pick really odd and unusual numbers. I'm going to focus on this chart now, and I'm going to demonstrate some of the apparencies that look very confusing. For example, it looks like these are identical, but really, when you zoom them in, you'll find out it's not. Now, I chose to go with trailing on this simply because, for the most part, and I've actually tested this carefully, it makes absolutely no difference profit-wise. And as you can see, when you really zoom in, the actual buy signal doesn't retrace until here, roughly an hour later. So this gives me an opportunity to let the market move down more in my favor, but is it such a small level of percentage that it does not actually affect my profit all that much. That is an important consideration for your retracement. Remember that a proper retracement for a trailing stop loss is always going to be the actual purchase point. That is, the price is never going to purchase until the market goes down and then retraces for a buy, or for a sell when the market goes up and then retraces for the sell. Let's actually play with these numbers right here, and you will see a dramatic difference. By actually changing these numbers and playing with them, you can see just how it affects your buys and your sells. So here, with a higher retracement, the market did drop and it got a lower price. But then you had to wait for it to retrace back up to the purchase before it actually made the final transaction. 0.5% is a common retracement. Too common for a lot of markets, and it can cause you greater losses. 0.5%, though, might be too small for a lot of markets, even though it does have an impact. So I chose what I felt was a reasonable loss ratio for retracement. This provides a reasonable amount of wait time before it makes the final call. The other thing that I did is I put the retracement or the trailing module before the dollar cost averaging module. So I want to actually be able to wait out the pricing, but then I want to be able to use the dollar cost averaging module's averaging algorithm to actually filter out what may or may not be in my best interests. For example, let's see if we can find it. Somewhere around here is a second purchase. Here it is. As you can see, the trailing detected it, but it did not make the dollar cost averaging module. Instead, I am above my profit boundary, and this would be a good place for a manual sell. Let's see if I can get this chart enlarged. So right here, this shows a buy signal, but I'm over my average line and over my profit line. So I would probably manually sell at this point. But again, that is something to weigh in with your risk assessment. From my standpoint, it is a relatively good process. Now, the next thing I want to bring to your attention is the number of purchases. Let's actually take a look. It says that in one particular purchase, that's right, one buy and one sell, TradingView thinks I'm going to make $369. There it is, one trade. And yet when you go to the list of trades, it shows you this one wonderful trade. I am using an $11 position. So the fact that it's going to make me $369 off of one single $11 position is absolute and pure rubbish. Do not believe this number in terms of profits. This number will help you fine-tune your trailing figures, but it's not going to be a realistic assessment that one $11 purchase is going to magically make you $369. That is not realistic. So the trailing module does skew numbers a lot. So does the coin you're choosing. Be sure you understand that with respect to the analyzer. If you believe these numbers, you are going to set yourself up for a very sore loss. don't believe the numbers. They are not correct. They are good enough to go to the next stage, which is paper trading. They are not real money. Make sure you take that into account when you're looking at your charts. And most often, you would simply be better off turning this off. I would actually believe this to be more accurate, with 2 trades making $22. This is more reasonably accurate, as it makes sense that a $22 position size total will likely make this kind of a profit. Although I personally don't believe it will, it at least has some valid value that can be weighed upon, particularly with this coin. This is a low-grade, low-quality coin, and one that I would use this recipe with. Band does not rate high enough for me to feel comfortable using a MACD parabolic SAR combination, but I would trade it comfortably with an Ichimoku cloud combination. And that brings us to the second step, which is the momentum. As you'll see, I have one very strange hot mess here, with some numbers way out in Neverland. That's because I am using a confirmation bias on my momentum. It's a very unique confirmation bias, and I mentioned it within the Jackrabbit support server. If you don't use Bitcoin very often, TradingView provides a symbol called Total 2 that does not count Bitcoin. I often leverage Bitcoin as a confirmation, so I prefer the messier chart. Then that is just Total. Be sure to refer to the Jackrabbit support area for Jackrabbit settings to get the name of this more clearly. But it is simply crypto cap total in all caps. Now for my momentum, for the confirmation, I made it identical in every way to the first one, with the exception of the symbol. What this does is it compares the momentum of the entire cryptocurrency market and makes sure it's in a trend, and the momentum of the actual coin and makes sure it's in a trend. So between the both of them, I have a confirmation of a trend that will most likely go in my direction. Again, very important and very consistent. I have not only done that with the Ichimoku recipe, I've also done that with the MACD parabolic stop and release recipe, where I use momentum the same way, taking into account the entire cryptocurrency market capital. And again, the same thing, it is set identical to the first momentum trend. That way, both the coin and the entire market are moving in a trend. And this will give me a better opportunity to find better prices and weed out unwanted signals. And that is important that you think about as you progress with your strategies. I would easily feel comfortable putting $100 positions on this recipe and not worry about the market. because I know even in a Black Thursday market, this recipe is going to remain consistent and well thought out. So even here, as you can see, very limited, very respectable, very consistent, nothing over the top. And that is exactly what I want from my trading. I want my trading to be sustainable at all times. I want to maximize my profits while I minimize my exposure. These kind of techniques will do just that. And as you can see, when you look at the 1 hour chart, the numbers are a little bit more reasonable in terms of what you would expect versus the 15-minute chart. And this is why it is so important that you really look at every single time frame. You want your maximum buys to be consistent in every single time frame, irregardless of how erroneous this number may be. Even the one exception to the rule for coins that simply may not be that good is the daily, simply because you may not have enough historical evidence at this level to trade a coin. It is important that you focus on your coin choices. Your recipes are going to determine how sustainable your trading is going to be. These two recipes excel in each and every market consistently, even the worst case markets. Black Thursday saw a lot of chaos for a lot of coins, and that brought a lot of problems to many people. Now we are going to take a look at Black Thursday, or particularly the February-March crash. It is important that you back test every single time frame. Look for opportunities that might be manual sells. Look for opportunities that you can leverage a platform-based trailing stop loss or take profit. Or if you simply want to use signals only to help ensure as high of a profit as you can get. There are a lot of different scenarios that you need to consider as part of your risk assessment. And those scenarios are very important. Do not take shortcuts in analyzing your coins. Make sure your research is full and complete. And as you can see, here we are getting to the Black Thursday collapse. This recipe did well. Nothing over the top, nothing out of the ordinary. And in fact, as you can see right here, it actually would have profited quite well. So if you were to set this to a flat DCA versus a strategy approach, it would get out of the market and you would have a very good and nice process. So there are a lot of different concerns and considerations you should make with your market capabilities. Those concerns should not be underscored at all. So right here, even in the midst of everybody panicking, you would have made a profit. Even if you went the long term and you just let the strategy do its thing. Let's see when it actually got out. It got out right here. But here it shows it's still in. So we need to follow this down some more. Okay, it made another purchase and accumulated. Here's another opportunity for another manual sell. More opportunities for manual sells. In fact, quite a few opportunities for manual sells. It looks like it would still be holding. So this is a case where it is simply waiting for the perfect opportunity. Okay, we're already into September, and finally, after all that time, it had the right opportunity. Now, are there better opportunities along the way? Yes, there are. But still, this is nothing to sneeze about. So you had plenty of opportunities to really get some generous and really nice profits if you simply wanted to get out a little early. But the fact that it waited so long shows that it knows how to handle the market even in a nasty situation with only $20 at risk. And this coin is often a difficult coin to work with. So this is where you have to pick the right recipe for your risk assessment. These values aren't all that impressive or meaningful. In all honesty, this value is your most important. The total number of purchases that you make is your total exposure. So even at this time frame, with Black Thursday and complete market chaos, this particular coin only had a maximum liability of $33 using an $11 position size. You can find many coins that do exceptionally well. Coins that normally have a very difficult history. And you can see this coin does exceptionally well also. There are a lot of good choices to make with a good, solid recipe. Whether you choose to go with an aggressive winter approach or a conservative winter approach, it doesn't matter. The advantages to a conservative winter approach is diversity. You don't need as much of a budget to trade a winter conservative approach. This particular recipe the Ichimoku Cloud would allow me, with a $1,000 budget, to easily and comfortably trade 50 different coins. Is it going to be the fastest? No. Is it going to work and come out with a profit? Yes. Now, I prefer the 1-minute candlestick. I prefer it because it gets me in and out with minimal exposure, but this is based upon a 3.5-day history. That gives me roughly 4 times the trade potential of the 5-minute candlestick. And I got that number simply because the 5-minute candlestick represents roughly 17 days. The 1-minute candlestick represents roughly 3.5 days, or rounded up 4 days. 4 days goes into 17 days 4 times. This means I have the potential of 4 times the trade versus the 5-minute candlestick. But I don't have to worry about an out-of-control budget. That is critical. So here I can rack up 50 coins on the 1-minute candlestick, and even with unusual market conditions of the 1-minute candlestick having gaps, good coins are going to do very well. Poor coins will have their problems, but they will still be considerably well done. So it is important that you really look at your choices. For example, a coin that has a very jaded history. This coin is a real pain in the butt. And yet, look at this profit with the Ichimoku Cloud. This is worth looking into as a trader. Yes, it is not a fast process. It is not trading leverage or futures or anything that's glorious looking. It's a dull, boring, sit and wait process. But I can live with this dull, boring sit and wait process simply because this is a very nice little candy. This makes this coin quite sweet, and one worth looking at in a market I normally would not even touch. That is the power of having reasonable, consistent, and sustainable recipes. Confirmation bias with market capital for the entire crypto market does an exceptional job in trend hunting. Picking good quality coins that have a reasonable budget level does also a good job. We can go through multiple coins, including coins that shouldn't even be on the books, and still come out with acceptable and reasonable profits on a very easy budget and time scale. Coins that would normally shouldn't even be traded actually look very good here. Let's take a look at a coin that, quite frankly, I don't know if you want to call it a jaded history or just a poor history, but this is a coin I would never trade. Never. I would never be caught dead with this coin in my portfolio. It is that bad of a coin for its history, in my personal opinion. Yet, even as bad as this coin is, I would be willing to risk $11 just to see it pull off a reasonable profit. So again, looking at your risks, looking at your budget, this is a good way to really and decisively figure out the best approach. As the market becomes more turbulent towards elections, you need to think about how that turbulence is going to affect your portfolio. Political winds change every 4 years. You need your portfolio to last 30 or more years. That kind of thinking is what is going to determine which approach you are going to use and how it is going to affect your own personal trading. Even with an aggressive winter recipe, there is only $44 at risk for a coin that is very poor quality. A reasonable risk level if you have the budget. Take the time to find the recipe that works best for your personal situation. Take the time to research your coins and filter each and every one of them appropriately. Do not take shortcuts. And most importantly, whether you use a paper trader or just TradingView's back testing, look at the charts, study them, see how the numbers actually move. While the numbers down here will give you an assessment of what might be worth looking at in a deeper review, they should not be considered the holy grail of trading. Something like this tells you this coin is poor. As you can see, it doesn't improve. Something like this tells you the coin should be looked at a little further. Is it worth investing real money in? Look at the analysis. Back test it. Look at it. See how it really looks. A $20 exposure. Not bad. Look at a second recipe. An $11 or $10 exposure. Even better. These are the kind of decisions you need to make to sustain your trading long term. Your first consideration needs to be your budget. Your second consideration needs to be your exposure. Then and only then do you actually think about how to get from here to here. Meaning, how do you get the recipe to give you the trade and eventually the profit? Your trade cycle isn't on a daily basis and shouldn't be. Your trade cycle starts from the first purchase to the last purchase. However long that trade cycle may take, whether it's a day, a week, or a month, doesn't matter. All that matters is the complete cycle itself and the profit you are going to get off of that cycle appropriately. As I said, I will post this link in the description. But for now, I think you get the point that I'm trying to make here with what is going to be a very long and difficult trading season for many people. It doesn't need to be, and it shouldn't be, if you plan for the worst case scenario before you start trading. Until next time.